Hello, everyone. Today on the final bar, my guest is Doug Busch from ChartSmarter, joining us from New York. Three stock ideas for you right about now. Overall, the equity environment continues to just surprise to the upside. I hate to say surprise, though, because I feel like if you've been following the charts, following the momentum long enough, this shouldn't be much of a surprise. It's narrow-led gains, mid caps, small caps not confirming it, but we've seen that before, and the uptrend is an uptrend until proven otherwise. Ladies and gentlemen, this is the final bar. Hello, everyone. Good afternoon and welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close to look at the markets together, pay attention to the charts, focus on where we see the trends evolving, where we see momentum shifts, and helping to connect the short-term movements of today with the long-term trends and how they're evolving. As I mentioned, this uptrend just continues. And if you look at the last 2 days, it feels like we took the night off and then into the next morning, it just continued exactly on this uptrend that we started in the afternoon of yesterday. Stocks continuing to push higher, driven by a couple key sectors: communication services and technology. And again, I've heard so much discussion, and I've even been a part of that at times since the February March lows about can the market rally on narrow leadership? And in some ways, it's not super narrow because the average stock is up from the lows, but in a lot of ways, it really is. In days like today, where you see the S&P up, the NASDAQ up, small caps down, it certainly raises red flags in my head. But again, if you've been following this trend long enough, you recognize that again, the uptrend has persisted under these conditions and certainly seems to have an appetite to continue to do so. We have a lot of great guests on the show, and I'm so thankful for all the guests we've had on so far this year. Today, we have Doug Busch joining us again from ChartSmarter. He's a fantastic stock picker. I'm excited to hear his take on things. Coming up next week, we have Joe Rabel on Tuesday from Rabel Stock Research. On Wednesday, Dave Landry joining us. And then on Thursday, Mark Young, from Wall Street Sentiment. Just as a reminder, we're taking actually the next 2 days off. So Thursday, Friday this week, the final bar will be on a bit of a hiatus as I truck my family down to Oregon, drive past Mount Rainier, and have hopefully a well-deserved break together. We'll be back full go on Monday. As a reminder, an event coming up on September 22nd, mark it down in your calendar, called Introducing StockCharts ACP. It's going to be right around lunchtime Eastern time. And what Chip Anderson, the founder of the company, Grayson Rose, and I from the management team, we're going to be sharing this new feature, ACP, which you can access off of your dashboard on StockCharts.com, but a fantastic, flexible, dynamic, fluid charting experience. We're going to have a lot of special guests sort of sharing the different components to the new platform. So hope you can join us on September 22nd. Let's get to our market recap. And as I mentioned, I feel like a bit of a broken record talking to you about the market rallying on narrow leadership. I feel like most shows over the last couple months could have probably used something like that as the subject line for the video. But that's the condition. And I'm not surprised by this anymore. And I think, those of you that have followed the show, I think you've seen that it's less focusing on what the market should do and focus on what it actually is doing. So let's look at the trends together and see what's happened. So the S&P closing up about 1% today, around 34.79. The NASDAQ 100 up over 2%. That was really the leadership today, with communication services, technology, and the number one and number two. It was sort of everything else after that. Mid caps down, small caps down almost 1%. So continuing this rotation away from small and mid caps and into mega cap tech and communication services. And that's been the theme, and it's certainly continued. Looking at a chart of the S&P 500 here, again, it's not a bad thing. The market keeps going higher. And if you look at my traditional stock market topping playbook, and I wrote an article on my blog here in the last week or two talking about a bull market top playbook and what it would look like, a checklist, and essentially is looking kind of like this. And this is these are sort of the early warning stages. You know, the market going higher, but with small and mid caps not confirming it, because what that in general suggests is people rotating away from the risk on sort of smaller, more speculative names and into the risk off, more conservative, more stronger blue chip sort of names. And what's happening now is that's technology. That's where people are going. It's the Apples and Microsofts and Shopify's and all these other names that people have been in. It's sort of like the winners that you're sort of getting back into and just riding them as much as possible. And the problem is that doesn't tend to be sustainable. Having said that, the uptrend is in play and it keeps going higher, which means you have to have recognized that well before now. And I'm assuming that this trend will continue higher until proven otherwise. And I think you have to place your bets that way. I think that's how you have to approach this market. The S&P right now is with an RSI almost to 77 on the daily chart, and an RSI above 80 is pretty rare on the broad S&P because that's an extreme up move, but we're pretty close to seeing that. It speaks to the extreme euphoria, certainly speaks to the need for some sort of pullback, some sort of digestion days to take an assessment of where we've come from and see if there's enough momentum to push us higher. But as you look back at the November to February period here, end of 2019, you can see that the overbought conditions were not the end. It was sort of the beginning of a topping process that didn't finally come until 2 to 3 months later, and maybe that is what we're sort of in the early stages of as we re-enter and near an extreme overbought condition here on the S&P 500. Let's look elsewhere on what's happened today, and then we'll get into some of the other charts and themes. So at other asset classes, bonds weaker today. The dollar ended up being about flat, but certainly more negative than positive, with 10-year yields going back up today. Gold and silver actually rallied pretty consistently. So, again, I cringe a little bit when people talk about gold as a safe haven. Stocks are up, which means gold should be down. For every example you show me of that, I can show you an example like today, which is stocks rally and gold and silver rallies on the same day. I would think of them independently, focus on the trends and how they're evolving. The trend in gold and silver is certainly stronger. And the chart of gold is actually an interesting one. Let's focus on that for just a minute. I think there's so much attention on, with good reason, on the NASDAQ and the leadership there. But, it's interesting to see something like gold bouncing off of support around 180. Obviously it went vertical, and that was that was sort of the theme a couple weeks ago, is sort of this exponential rise in gold. We're looking at the last 6 months here just to zoom in a little bit. And then you had this pullback, and we retraced just about 38.2% of the June to August rally. That was sort of that, the lower end of this base for May and June. We then broke to new highs. So I'm taking that swing low and connecting it to where we saw here. The gap down pushed the GLD right to 180, which is a 38.2% retracement. We then bounced off. We're now testing it again, and today we saw a nice rally for gold and silver off of that support level. We just continue to confirm that as a key line in the sand, and I think 180 holding on the GLD and the similar level on the spot gold index is an interesting one to watch, because if we would break down through that, it certainly would speak to more of a rotation away from precious metals and into other places. But at this point, I think it's setting up to be a pretty interesting support level with potential for further upside, even retesting the highs as we move forward here. In terms of sectors, we talked about the leadership. On the downside, you have energy, utilities, real estate, financials, healthcare coming from weakest up the list there. And energy, as we've talked about from a technical perspective, a pure technical perspective, I think it's challenging to find a lot of opportunities there, especially in large cap energy with that have good technical characteristics relative to the rest of the market. It's the relative strength that's most painful there. Utilities as well. And when you look at the chart of utilities, you can see it's rolling over a little bit. And again, this sort of fits into that risk on theme, and you're rotating away from defensives like utilities. You can see we're breaking to new swing lows here for the last month or two, but the relative strength is really the painful part for utilities. So if you start the clock at the March market low, since then it's essentially been a pretty steady downtrend. A number of these times it's felt like, all right, this is a roll up on relative strength, starting to improve, making a new swing high, but then it immediately keeps going down. So certainly, while the price has held up okay, and on an absolute basis, it's holding up okay. When you compare it to all the other charts out there, it's certainly one of the weaker charts that I could come up with. And looking at the 11 S&P sectors, arguably the weakest, with energy being probably the definite weakest out of the 11. Just to finish off our market recap on here, I just want to point out, you had some big moves on stocks like Netflix, Salesforce.com, which is now joining the Dow, some of these other mega cap, large cap names. Apple is the number 2 ranked stock on our Scooter reports. And while that on its own is not necessarily news, when you think of narrow leadership, one of the anecdotal ways you can identify that is if you see mega cap name, the huge names like Apple at the top of the list. If a large mega cap name like Apple is one of the top 10 trends, that tells you how strong the chart of the S&P is most likely going to be, because it alone can force the S&P much higher than other things. So Salesforce.com, Apple, Amazon, some significant names there in the top 10. But the move in Netflix is certainly a meaningful one. And when you think about moves like this, it in some ways follows a very classic buy on the dips playbook, which is a long uptrend and buy when a stock pulls back to an ascending 50-day moving average. That's a general approach that has stood the test of time. And a lot of trading models, even simple trading systems, are built off of buying when you pull back to the 50-day. And so far, that appears to have been a pretty winning strategy for Netflix. Interestingly, as the RSI pulled right just above the 40 level, which is sort of that bottoming in a bull market phase, that's where you tend to expect it. That's our market recap for today. I want to take a quick commercial break. Back with my guest, Doug Busch. We'll see you in a minute. Hey everyone, welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. As a reminder, we'd love to hear from you, answer your questions about the markets, about particular charts, indicators, whatever's on your mind. We'd love to hear about it and hopefully answer one of your questions on the air. 2 ways to get your questions to us. Number 1, via email, thefinalbar@StockCharts.com, or on Twitter, tag us in a comment at FinalBarSCTV. And anywhere you see our content on YouTube or elsewhere, just put a comment below the video. We'll capture all of those and answer as many of your questions as we can. I want to welcome on my guest back to the show, Doug Busch from ChartSmarter. Doug, I think of you as a stock picker, and I appreciate you bringing 3 ideas for us to go through. Welcome back to the show.
Thanks so much, Dave. Thanks for having me on again. Always a pleasure.
So, I'm very curious to hear sort of how you're approaching things. We're starting in the healthcare space with Zoetis ZTS. But obviously, we're in this condition where the S&P just continues to push higher. Walk us through these 3 names and how it fits into your perspective here.
Yeah, first of all, today, Dave, just the last time I was on, actually, I profiled a few of these names, and I wanted to expand upon it with my animal spirits theme in this niche healthcare area. I think it's a good lesson to let winners run, staying with stocks that have done well. In fact, I read a recent tweet, I think by a guy named James Jude, that stated that, if you have a nice plan and your stocks are working out and you get the itch to exit premature from a winner, remember, if you're taking the train to California, you don't want to get off in Chicago. So I thought that was pretty good. I really like that one. But getting back to the the animal theme, I think we all know how much people love pets. We look no further than Chewy. It's up a double this year. And a couple of the names today were spin-offs from Big Pharma and Pfizer and Lilly, trying to take advantage of this trend. A quick note, Dave, I know you were talking about the Dow additions before, and I don't think there's any way that anyone on the selection committee for the Dow is a technician, as Pfizer is actually looking pretty good to me. I mean, with Exxon and Raytheon. But anyway, let's get into the individual ideas here. I hope everyone can see the chart of Zoetis here, ZTS. I hope I pronounced that right. This is a spin-off from Pfizer. Started trading in late 2012. I'm a big round number theory guy. It's has some problems with that round 160 number. Each of the last 3 weeks was above it intra-week. This week, again, is pushing up right against it, being rejected so far with 0 weekly close above it. The last 3 weeks also have closed very tight, all within just about $1.83 of each other's, and, just off all-time highs, and breaks above that type of digestion tend to be very powerful if they occur, Dave. It's a good sign the last 2.5 weeks have digested this 10% gain for the weeks ending 7/31 and 8/7. I think you enter with a buy stop above 160.25. I see that's the circle there. If it does break out, it carries a measured move to 178. I think you use a stop of 155. All right, if you can go on to the second chart, that'd be great, Dave. And that's Catalent, probably one not many are really familiar with, symbol CTLT. Quick reminder, this does report earnings before the open next Monday. On that note, it has recorded 3 straight positive earning reactions, up to 0.9 and 0.4% the last 3 times. Keep in mind, the best breakouts, we know they tend to work right away, Dave. The next best thing is to digest that move and not give up the breakout pivot. It's now hovering, you can see, just below that round 90 number. It's actually had just 2 closes above it in the last month. And studies have shown that names that trade decisively above that round 90 number tend to go on to trade to par and above. So I think that's a key level. I still think you can see here it broke above. It's holding this nice 80.62 break above a cup-based pivot from about a month ago. Like I said, I think you can enter here. You can actually add to it with a close above 91. I think you use a stop of 81 there. And last, if you could bring up the chart of ELAN. Okay, so here we have Elanco Animal Health. Yeah, this one is probably the one out of the 3 trying to play catch up. It is the laggard of the 3. But, to be frank, it's doing a pretty good job as of late. This here is the weekly chart, but the daily chart was trying to show great relative strength this week so far, up about 5%. It recorded its first positive earning reaction on 7/30, jumping more than 6%. The prior 3 all fell. The last 3 months, great relative strength, up about 50%, and it's acting well post-breakout from a bullish ascending triangle pivot of 25. This here is the weekly chart, and believe it or not, last week actually completed its first 4-week winning streak ever since it came public, or it started trading back in September of 2018. The one caveat I do have, actually, obviously you can see it's made 4 lower highs on this weekly chart. For me to get really excited about it, would have to break above that 32 level and break that series of lower highs. And
so 3 great charts, Doug. And it strikes me, I always talk about a rotation from distribution to accumulation. You can also almost see it on the last chart, Elanco, where it's, the underperformance versus healthcare. But you see the rotation higher in the last, month or two, really breaking that relative downtrend, it appears.
Yeah, and actually, I do apologize. I thought I sent you the daily chart, but if people were to look at the daily chart, it's 200-day moving average. Actually, for the first time in 2020, is actually starting to flatline. It's not actually sloping higher just yet, but it's starting to flatline for the first time. And many people actually use that to define the overall trend. So if this can start sloping higher, you can see that bullish ascending triangle right around the 25 level. It was resistance in April, resistance in June again, July, and then broke above it. I'm a big fan of this chart. I really am.
Those are 3 great ideas. Doug, thanks so much for coming back on the show. Thanks for walking us through your perspective. And as always, hope you stay safe and hope to have you back on the show soon. All right.
Have a great trip to Oregon, Dave.
Thanks so much.
Thanks.
It's Doug Busch from ChartSmarter joining us from New York. And again, I think of Doug. Doug's one of those guys I think of just a really talented stock picker, someone who has a good sense of the names and what to pay attention to. And I think he's hit on three stocks within healthcare. It's funny, we talk about the healthcare sector and how on a relative basis it's been so challenged. But if you look at it, it's, big pharma that's been struggling, biotech for sure on a relative basis, a little challenged. But if you look in other places in medical supplies, equipment, some of these stocks that Doug shared with us, there are opportunities in there. I think that's what's encouraging for stock pickers. There are opportunities even in sectors that may feel more like an underweight right now. I want to get on to our next segment called Dialing Up Dividends. I'll be honest with you, I've hesitated to refer to this one and include it too much in the show, only because over the last 6 months, during the coronavirus experience, so many companies started to, pause dividends, cancel dividends, restate dividends, and sort of change them. So I didn't want to do a ton. I wanted to bring it back though, because I think especially now as the markets, continue to push to new highs, I'm always thinking about that alternate hypothesis. What if today is the high? I don't know if that's going to be the case, but what if it is? And at what point am I going to feel good having more income generating opportunities in the portfolio and be looking for opportunities that are going to hold up during a potential downturn? So I just wanted to use our screening tool and look for some higher dividend paying stocks just to walk through them a little bit. I did want to start off with a bit of a correction. So yesterday during the show, a couple people pointed out, I was talking about semiconductors, SMH, and as I was bringing it up, you may have heard the surprise in my voice as I looked at a dividend yield, which was over 4%. I mean, I remember looking and thinking, wow, it's actually pretty decent. It did not make sense to me at the time. As some people rightly pointed out, we had a data glitch. It just had the wrong yield in there. Sorry for that. We've corrected it. And the correct yield is just about 1.2%, which sounds about right for semiconductors. So apologies for the miss, and thanks for a number of you that pointed out that mistake. I will be the first to tell you, and my wife and kids will be the second and third, that I am not perfect. Let's get on to the next segment here, dialing up dividends. So what I did was I actually used the screening tool on StockCharts, and here's what I did. Usually when we're using the screening tool, I tend to keep it to the S&P 500 just to keep it to names that we're all familiar with, and then I'll know when we bring them up, it's probably something you've heard of. I'm going to do something a little different today, and as I'm doing it, we're going to look at mid-cap and small-cap stocks. I would just encourage you, with some of these names you're less familiar with, certainly spend some time, and do not use what I'm showing you as a reason to just make some sort of decisions on it. I would encourage you, as always, to do your homework and be comfortable with what these companies are, what they're doing, and especially now as we think about dividends, there's the challenge, there's this dividend risk, this risk of dividend continuity, and making sure you're comfortable with a reasonable expectation that a dividend trend is going to continue, right? A dividend stream is going to be as expected. So with that as a start, let me show you what I did. I looked for stocks in the mid-cap and small-cap S&P indexes, a yield over 5%, which is immediately putting you in a pretty small subset of those indexes, which I totally get. And I'm looking for scooter rankings above 70, which means it's in the top 30% of each of those universes. And if you know how the scooter rankings work, there's a large cap silo, a mid cap silo, a small cap silo, and stocks are rated against that cap tier, that universe, right? So above 70 means it's two different groups, mid caps and small caps, and you're in the top 30% of either of those. So what that does when you screen on them, it immediately is going to point you to certain sectors where there's enough of a dividend to justify, or to pay out this sort of thing. So you're automatically going to be in some of the less risky parts of the market. Just in general, that's just how you're going to generally point to. But this is what the results. 9 stocks came out of that when I ran this about an hour ago. 2 in consumer, the rest energy, materials, real estate, and 1 in financials, Waddell and Reed. What I wanted to do is just look at some of these charts together, and as a reminder, I mean, I'd encourage you to do your homework on any of these and just be familiar with what these companies are, and if you're comfortable with it. Signet Jewelers was the one in consumer discretionary that came out. This is a small cap stock, a market cap of below 1 billion, but a yield about 6.5%. What's interesting about this, you think about a lot of the S&P names we've talked about, hitting the June peak, pulling back, and now retesting that June high, and the Mindful Six. That's a group of stocks that we've looked at. It's all about where they're at relative to that June high, and one by one, it feels like they're starting to eclipse that if they haven't already. Signet is actually approaching that level on a closing basis, almost did it right to the penny today. So we'll see during the remainder of the week. It's up 6% today, so a pretty meaningful rise. And I'm looking at this relative to the S&P 500. So you're getting a bit of a market cap effect, that you're looking at a small cap name versus a large cap index. But having noted that, it's up on a relative basis pretty good over the last month. If you just look at where it was at the end of July versus where it is now, that's actually a big percentage swing, because it's gone from 10 up to almost 17 in the course of 2 months. Chart number 2, B&G Foods. This is ticker BGS. This is within consumer staples. It's actually a pretty decent, slow and steady uptrend. There's a stock that yields over 6%. Again, a small cap name, $2 billion market cap. And potentially in a normal world, I would look at this as a bearish divergence and get a little nervous. However, the market has effectively shrugged off all bearish divergences in recent months. So I think I'm numb to that as a potential topping signal, and respecting more the fact that it's been a consistent uptrend, especially on a relative basis. It's actually held up pretty well. AM, Antero Midstream. It's interesting. Someone actually pointed this stock out when I was talking about energy, because I was talking about the relatively weaker charts across the energy space, and a couple of people actually pointed out some of the mid cap and small cap stocks within energy that looked a little more constructive. And you're right, AM is a mid cap stock. The yield is pretty high. It's over 17% now. It pays a hefty dividend, and the price is so low. I mean, this has gone from almost 175 as a close here in March to now just a 7 handle down to 695 today, down 4.5%. But overall, the trend has been relatively positive, with the RSI remaining for the most part in sort of a bullish configuration overall. A lot of volatility in some of these small and mid cap names, obviously, when you look on a price basis, for sure. Also in energy, ETRN. And again, when you get into energy, I'm always a little, want to pay attention to the business structures and make sure you're comfortable with it. But this is a stock that yields over 11% in the mid-cap space. Again, I like the RSI that's been in a bullish configuration compared to the average energy stock. And I think this is a reminder of what a number of you pointed out, which is if you're looking at energy, looking in mid-cap and small-cap could be some opportunities that in large-cap energy you don't see it. Only one financial came up on my screen. That was Waddell & Reed, WDR. It's a small cap name, so market cap just over 1 billion now, yielding over 6%. And on a relative basis, it's not my favorite chart, but the price has held up pretty well. So you're getting decent yield on a chart that's still technically in an uptrend. Although overall, again, it's hard to argue against some of the more stronger trends. This is an example of where the RSI sort of is in dead neutral range, has not broken above 60 or below 40 in a couple months. And what that tells you is the trend is not up, it's not down, it's sideways. And you're really waiting for a breakout above resistance or below support. So at this point, a break above 16, below 1450 would really be the thing to look for. That's all the time we have for this. And again, I'd encourage you to run screens looking for higher yielding names. Go outside of large caps a little bit, and as always, just make sure you're comfortable with what those names are and what the companies do, and make sure you're comfortable with the particular bets you're making. We need to wrap up the show. Go to the 3 and 3 charts in 3 minutes. Here we go. Chart number 1 is looking at communication services. So today's up move was really driven by a narrow group of sectors, primarily communication services and technology. So comm services was up pretty big today. The relative strength has broken to a new 12-month high, a new multi-year high, really. Technology sort of has broken to new highs as well, but has been on a slow and steady uptrend. Communication services as a sector sort of joining that as well. So overall, looking at those two along with consumer discretionary, really the 3 strongest charts on a relative basis. Where you do not see charts strength, looking at chart number 2, is utilities. We looked earlier in a little bit about the relative underperformance of utilities, which is what's most difficult for me. These are names that tend to be higher yielding names, which is why I was thinking of it in the context of dividend yield, but the price performance just has not been there. And being in a higher yielding name where you're just getting crushed on a relative basis in this market environment, you're missing out on obviously the capital appreciation on some of those better performing stocks. Finally, just looking outside of equities, I'd encourage you to look at gold and precious metals, gold and silver, in particular, the GLD bouncing off of 180. So long as it remains above 180, I think that cyclical uptrend is in place. We break below 180, I think you have to be a little concerned about the potential for a deeper pullback in precious metals. Folks, that's our show for today. I want to thank Doug Busch from ChartSmarter joining us from New York today. giving us 3 stock ideas within healthcare. As a reminder, we're going to be taking Thursday and Friday off this week, going to Oregon with the family. We'll be back full go on Monday. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.